Good afternoon or good day, depending on when you get this, where you are, what time. My name is Doug Lennox, and I welcome you to Smart Money Moves. I'm with Adam Recker. Adam is our equity guy, but he's actually more than that. So he's everything. I think of him as everything. There's so much happening. Speaking of everything, we've got tech stocks going up and down. We've got volatility pretty much in the market on a daily basis. People are wondering what's happening. We don't know if it's just going to go to the moon or maybe fall down. And so there are a lot of narratives out there, and the guy that's going to figure them all out for all of you is luckily my co-host. So Adam, I'm just going to throw it over to you. How's that? What should we know?
No, that works. So I think there's quite,
Works.
quite a bit, quite a bit going on. I think to kind of jump into it, we can flip to the first slide. But on a timely note, I mean, we had the Fed update today, and so they held rates steady. There's some dissent, some wanted cuts. I think two individuals in particular wanted a 25 basis point cut. We'll probably come back to that here again in a second. But for the meantime, maintaining the status quo. From a market perspective, things have been positive again in the brief start to the year. Following a strong year, we have positive returns for both the S&P 500, world markets, et cetera. And going forward, the conventional wisdom is there's reason to expect more positive returns in 2026.
So the
And so
market is that kind of what when people say what the market telling us, that's what it's telling us?
yeah, there's things we look at, and so if we go to the next slide to kind of dive into it, I know a big topic of conversation that matters. One of the variables that drives the market are valuation levels. That is something that definitely matters over the long run. But another key factor is earnings growth. And so when we look at earnings growth for 2026, whether it's the U.S. as we have on the screen, but even the world markets as well. Generally speaking, we're still expecting positive earnings, and as long as earnings continue to increase, sentiment doesn't completely deteriorate, we can still expect positive returns for the market. In this case, S&P 500, as of recent updates, calling for call it nearly 15% earnings growth, which would be pretty healthy. You can see that much of it is still expected to be driven by tech, which there's some risk there, but it's also broadened out a little bit where you see things like traditional value sectors, whether it's materials, industrials, expecting positive returns or earnings growth as well, can create some confidence that it could be maybe some healthier growth, not so much just Mag 7. And that's why we take a diversified approach. And so all in all, still reason to be optimistic while not at the same time be completely ignorant of risks out there. Same note, the
You're
next.
optimistic, and then strategically, you've kind of your general strategy, given your sense of things, is as you've described it. What can our clients expect, and then those of our viewers that are going to become our clients.
Yeah, and key one, while I think it bears repeating, it gets it a lot, but diversify. I think the next chart kind of speaks to it in a sense, where this concept of dispersion is going to come up again later, I believe. And repetition is how you get things to stick a little bit more. But even looking at something like tech and the broader market, as we'll show in a different view, dispersion has generally widened, meaning, for a time, maybe certain stocks or certain segments of the market, say in the tech sector in this instance, many of them move somewhat in lockstep, all benefiting from a rising tide. But more recently, you can see the pack is separated a little bit. Google has done well, and then some of the others have fallen by the wayside. Why that's interesting is, some will look at it and say maybe it's easier to pick the winners when dispersion is high. And that's not necessarily the case. In fact, it may be more difficult, or at least the penalty for being wrong could be higher. Because if we look back a couple months, even later back in 2025, Google wasn't doing as well. People were criticizing, saying, hey, they're behind on the AI arms race. They're not spending as much. Like, what gives? And then, there's some developments, release some new models, things like that, get into the fray, and they do really, really well. and then the narrative changes. And you have to be the only way to really prepare for that, given how unknowable things are, is to be a little bit more diversified and exposed to those particular themes, albeit in a controlled manner. And
Well,
so
interesting. That kind of gets into, at we get bombarded, we, the consuming public, with headlines and this is and that's, and we're watching programs maybe, or we're not, but we're hearing all this stuff. And that at least sends a message to some folks, I better do something. How do you think about that? It's that impulse to act. I better act, and then I have to act again today, and then tomorrow, and so on.
I think you spend just a little bit more time thinking is the point first before you start acting. I mean, even these topics, like some of the other impulses out there, that we've kind of discussed in past days, like you see rising gold prices or silver, and people are wondering, well, should I do something with that? It's going up a lot. I don't want to miss out. Well, and the answer isn't always broad based. It can depend on your particular search situation. Why do you want it? Do you have the right mindset for it? Because while something like gold has been a good store of value over centuries and decades, it's still not immune from having prolonged 70% drawdowns while still being a good store of value. And so you kind of have to sit and think, is this really something that's right for my plan, or do I just really want to own it because I've seen it go up
Yeah,
recently, or am I going to own it in a disciplined manner? Or is it better for me to own stocks where over a 20-year period we expect positive returns and to keep up with purchasing power? Maybe that's a better way of doing it. And so you have to sit and think about those things opposed to just acting on it. Or energy. Everybody thinks it's going to be a mild winter. That's how a lot of hedge funds were positioned. Then they get caught off sides with this cold snap we've had, and you see natural gas prices go up. And so they have to
yeah.
cover shorts. Like there's a lot of things that you think are going to happen, but then you're surprised. So you need to think a little bit more. Or even the perpetual uncertainty around inflation, interest rates, which are hard to focus on or predict, AI, constant questions about that. A lot of times, given how uncertain, how fast things move, it's better to again take a breath, sit and think, and really collaborate with the members of your team to make sure these are decisions that make sense for the long run and they aren't just knee jerk reactions.
Well, I like that. And what should, when you think about what people pay attention to, we've introduced some behavioral concepts, but what should people pay attention to both emotionally and financially?
Yeah, I think measuring the emotion and taking a second to think, why am I acting the way I am? What's driving other people's action is always good. Because as they say, you want to be kind of a little bit more greedy maybe when others are fearful when they're greedy, kind of thing. Make sure we're not getting kind of sucked in with the herd.
That was
Um,
the Warren Buffett stuff you just said. That was good Warren Buffett
yeah,
stuff,
here he's a
literally.
pretty smart guy.
Yeah.
But on the next slide kind of speaks to it. And so certain things we'll monitor, and it doesn't necessarily drive action, but it's like, well, how are people generally positioned? And it helps you kind of think like, well, what's going on in the market and why are there risks that we should be aware of? And so like fear and greed indexes, there's different subcomponents around it that can drive it, but it bounces around quite a bit because people react to headlines and things like that. And so I looked at this probably a few days ago, we were more neutral. But you look at it a year ago, it was a fear reading, and then more recently, more greed. And it's why is that? And it can be a couple different things. Like part of the greed is really a sign of being afraid of missing out on the upside. Here, there may be a generational opportunity for AI advancement and things like that. I want to participate. If it's as good
Yeah.
as they say it is, I want to be a part of it. But at the same time, there's volatility in individual stocks, maybe concentrated stocks people own, tech stocks that can create fear, or even just the fact that stocks have gone up a lot over the past couple of years. People feel maybe
Well,
there's
and this when we look at this too, when I look at this, Adam, one of the influences in my life in the behavioral financial space is Hersh Shefrin, and he actually wrote a book which some of our viewers may have read some years back called Beyond Greed and Fear. This being the Fear and Greed Index, and And one of the things that he talks about is of course how emotions actually influence decisions. And we have a tool at the Mather Group. We call it the 4 R's that we use for ourselves, even just to deal with life in general, that I'll just share with all of you as investors that will help you understand kind of where you might be at on the various curves here. But we call it 4 R's, and the first R is to recognize. And the recognize R, we have a game that I encourage you to consider playing. I think we introduced it once before, but not all of you probably started practicing. But if you do, it'll change your life. It's the freeze game. And just every once in a while throughout the day, hit the pause button and just ask yourself these questions. What am I thinking right now? Emotionally, how am I feeling right now? What are my emotions right now? And physically, what's happening with me right now? Now, if you notice your emotional state to be really heightened, you're in a position where your cognitive thinking will be impaired. Your judgment gets a little impaired when you get a little riled up. So our brains are wired to help us avoid danger and take advantage of opportunity. The wiring is triggered by the emotions, and the emotions trigger us to emote. And what Adam is encouraging us to do, which I agree with, is think mode. So before you emote, do a little thinking and kind of register where you're at. Play that freeze game, recognize, and then reflect. That's now when I'm reflecting on the big picture, I start to get my rational brain back. And that allows for me to do some reframing, changing my mind a little bit, and then maybe respond differently than I might have if I had responded emotionally. So I
Yeah.
thought I'd throw that in there right then. And let me throw it back to you for more of what's really happening.
Yeah, no, it's a good point. And I think sometimes the criticism it feels a little touchy-feely in a way, but we got to monitor the actual hard data and make decisions in an unbiased way, at least as possible, as much as we can. But the people making those decisions, interpreting it, are human. They have biases. You can be in an emotional state, whether it's because you're tired, hungry, you name it. And so you got to sit back and think like, well, why am I acting this way? Why are others acting this way in response to the data? In the case of greed here, you can hear there's widespread concern. People talk about being afraid and talk about concerns, especially consumer sentiment and things like that being very, very low. That being said, people aren't necessarily acting on it, which means it's greedy. Like I'm afraid of the market, but I'm not de-risking. Or I'm afraid about being able to spend, but I'm still going to take that vacation. I'm not going to like it, but I'm going to take it. It's like so it's interesting. Like people will say one thing and do another, and you got to be aware of that too.
Well,
Um,
what you just said so important. One of the things that many of you have already experienced in your life is this gap between knowing something, deciding to do something about it, and then actually doing it. And that's what you just said. So the doing it part, even though you know better, is really hard. And that's where your wealth advisor and the team of people here will help you out.
and I think that's where some of those behavioral dynamics may have come into play. Maybe on the next slide, as a good segue. And I can speak to it as you have been. Because there's a number of things you may have to confront. It's the things that happened recently. We're going to feel like they're going to keep on happening, like recency bias. So may not want to make a change because of that. Or the fact that while we like making money, it feels really, really good. Losses feel twice as painful. There's a lot of studies on that, and that affects our changes that we may make. Or the narratives we hear in the media. There's nothing more powerful than a good story. And that's really good at getting people to take action that may not be in their best interest.
Well,
Because
and these, by the way, are the ones that typically drive a lot of the shows. We try not, we don't have that kind of throw yourself around kind of thing here. But that's what's happening on a lot of the financial shows. They're telling compelling stories and they do influence decisions more than fundamentals. I appreciate you identifying that one.
Yeah. And it's definitely not tailored to the individual either. I mean, it's for a mass market audience. And so, and then again, just all of these things are taking place. It makes you compelled to feel like I must do something because doing nothing, is scary. When sometimes taking a pause and avoiding action may be the right course of action. And so we don't
Yeah.
always need to be doing something for the sake of doing something.
Well, I love what you just said there because that's oftentimes the fourth R is the respond R. And sometimes after one reflects and one kind of does a little reframing, that response is do nothing because the financial advisor and the team, the wealth advisors worked with you and has prepared you for uncertainty. So we actually already know there's uncertainty. And so one of the things that we try to do is prepare for the uncertain times. And Adam and his team do that, and the wealth advisors do that. That's what we do with all of our clients. So, but I like this slide a lot. But it also reminds me in my own career, back in when I was long ago, I was a senior executive at American Express, and we were building a company in England and I was responsible for part of the company, and I was looking not at these so much. Some of it was recency, but one of the things that really hurt me was confirmation bias. I was looking so hard. Actually wasn't even looking hard when confirmation is bias is so strong that I didn't even have to look hard to find it. So I was looking for stuff that confirmed my position already, and I found it. And so I was guilty of confirmation bias, excessive optimism. It's good to be optimistic, but excessive in when that precedes the word optimistic, it's not good anymore. That's why they call it excessive. And overconfidence. It's good to be confident, but overconfidence is too much. I was all of those things. And it cost us a lot of money, but it also, we learned a lot in the process that helped us understand that. Some of what we learned we're sharing with you. So thank you for bringing biases up. For those of you who are wondering about yourself, am I personally biased? The answer is yes. Oh, so, and that's why you want to play the four R's because you want to actually do as best you can at making a rational decision in the presence of all those biases. That's hard. That's why you have Adam Recker. That's why we love Adam.
It gives us something to work on. So,
Yeah.
but again, to avoid some of those biases, it comes back to again looking at data. Trying to review in a very impartial manner. That's why, again, like next chart, we're reviewing things like the aforementioned, I think, dispersion, where different you look at it from different angles. You can see, and this is opposed to being just tech stocks, the broader based markets, because not just, it's not a single market. There's multiple markets in the world. There's sectors that roll up to geographic markets based on market cap, so size of companies, regions, all the way up until a well diversified world. And that can help us glean insights around how healthy is the market at this point. Or looking at things like profit margins on the next page, where again, trying to parse through the data, we can see that for one, a lot of the profit margin expansion has taken place in tech. There's been a lot of earnings growth. That's why valuation levels are so high. And so, from one perspective, you can interpret it as saying, well, some of the valuation may be justified right now. But it also entails additional risk and maybe opportunity, where if margins are at peaks, valuation levels are at peaks, you can see how a misstep in earnings, perhaps maybe AI doesn't live up to the hype or something else happens on the horizon, you see how that could cause a knock on effect where things fall. Or from another perspective, operating margins are positive and have been good for the tech sectors. If AI works, and this is a view that many have taken, there is a lot of room for improvement for other companies from a profitability perspective. And so, opposed to just tech being the winner, the rising tide of profitability lifts all boats, and you may actually see better performance from areas that have more attractive valuations that have been out of favor. And so, lean on more of the data and use that then to make key decisions. Any pause there? Anything, Doug? Otherwise, I mean, we can kind of
What I think is that,
decisions.
when you look at the data, and what I find a lot of times, because, and it gets back to these behavioral biases, the data is not as persuasive as we would like it to be. And I do believe this is where I really believe the human intervention really helps us make better decisions. I think there's, because we mentioned artificial intelligence, and artificial intelligence can do a lot of calculations and even do a lot of recommendations. But what it can't do is get inside and feel with us how we're feeling right now because of all the things that are going on and help us sort it out. And
Yeah,
that interaction, I think, so when I look at this and I look at, to me, I personally am optimistic, but I've already said my concern is, am I overly optimistic? But I start with being optimistic. And long term, even if things are at their peak right now, for the short term, they aren't for the long term. So
yeah,
I'm a long term guy. I believe 10 years from now, things will be better. It's between now and then. And I think what we do for clients, what you do for clients and our advisory team, is we really help people be positioned such that whenever they need money, at whatever time in life they need it, and for whatever reason they need it, there will be a smart place to get it. And
yeah,
and that comprehensive advice is what allows us to prepare people for the truth. And the truth is uncertainty.
yeah.
Fortunately, we have people like Adam who've built models that increase the odds of certain things happening in our favor if we make certain decisions. That's what they do. But we're still not sure of what's going to happen, and we're prepared for that. And I just
Yeah.
want to emphasize that point. I don't know if you'd comment on that because you've got you're a CFA. I mean, and for people who don't know, that's really hard to be that. You're
Yeah.
more. I mean, the intellectual horsepower is significant, but you've got an understanding of the human side that actually matters more now than all that mental horsepower, which matters still a lot. So
Like you
each,
said, you gotta get through that between now and then period to reap the rewards that come when you reach that other state. And so I think to help do that, though, there's decisions that have to be made. And so, some of the key decisions, it always comes down to like what kind of exposure do we have? And so do we want to be more concentrated in certain areas? Generally, the answer is no, because while concentration can lead to wealth creation, it introduces unnecessary, uncompensated risk where any random company picked is likely to underperform an index. And so we want to be aware of growing concentration, whether it's in tech, which again, we're not saying that the concentration itself is again sign of a bubble. Some of it is justified by earnings and things like that, but we don't want it to be compounded by maybe a single stock position that's even outside of the indexes that we hold. Like we have to be aware of the exposure. So trying to be as diversified as possible and as appropriate for each individual client based on their specific circumstance.
well,
Or
which I think is a really important point you keep making. It's really very individualized to the specific circumstances of each client, what they care about, their values, what their goals are, where they're at in their particular life. And I really like what you're talking about, which is you're talking about the decisions that matter most, and you got to make some choices, and helping people decide which is most important to you is critical. That's why it's so personalized. So that's decision one, exposure versus concentration, right?
There's risk levels to decide. How safe do you want to be? How much growth do you want to seek? Somewhere in between. Again, the constant struggle is that media, other forces are going to try and force from one extreme to the other to spur action. And so we can look at things and see, like, well, how are people behaving? And so this was just kind of an interesting chart we had found, looking at put calls ratio. The simple interpretation for the sake of time is the lower the number it gets, the less hedging is taking place from a downside perspective, and the more risk seeking investors are. And so you can see as the market has run, there's been less downside protection in the market because people are taking on more risk, kind of with a greed. Uh,
Well, and you know what we find to be true, and I'll just mention this, that a lot of individuals, as investors, they look at what goes on, and then they approach somebody in the financial world, and they say, I'm been thinking about it and I'm prepared to take on more risk. We've learned to interpret that. What most people really mean is, upon reflection, I'm prepared to take on a higher reward. So I've been noticing a lot of people are getting bigger returns, and they say they do that by taking a risk. I'll do that. So what they're saying is, I would like that return.
yep,
But what we're talking about is taking risk could expose us to loss, and what Adam is preparing us all for is the possibilities. And then when we get into safety, safety is like cash in my pocket. That's safe, other than from robbery, but it's right there, and I got it. And it's very liquid. It's very available. But growth, I got to take different risks. So I really like how you're describing this.
yep. And then through all this, we got to be very intentional. We don't want to be overreacting. I mean, it's hard because things are moving faster than ever. Even like the companies within the S&P 500, they're getting disrupted faster and faster. In the past, they would be in the index for a while, but the turnover, it's increased. And so now I think the average company is getting kicked out faster and faster. Holding periods for stocks, individual investors used to hold for 7, 8 years. Now it's falling down to less than a year in many cases. And so we want to make sure we are doing things that are intentional. We're not overreacting. We're taking a longer view of of the plan, opposed to, again, getting whiplash by all of the noise out there. Because again, the next slide shows we have to be prepared for volatility. Even in a year where we have positive earnings expectations, we think the market should go up. In good years, there's still expected to be, there can be double-digit drawdowns any given year, even in a good year. And we have to be prepared that those are going to happen, because we don't want to be scared out of the market. We want to control, we want to rebalance as appropriate. Because if we get, again, scared out of the market, especially in something that's just a temporary blip on a long scale, just missing a few of the best days can have tremendous impacts on the long-term performance of a portfolio. If you get out the wrong time and you don't get back in, you can miss out on those best days that tend to be clustered around some of those worst days in the market too.
And by the way, if we're prepared and you need to put your hands on some money on one of those worst days, that's not the place you get the money. You're prepared for that to be possible. This brings us, we got a minute or two left, the questions. You want to review those real quick that investors should be asking?
Yeah, and so these are not necessarily things that will be solved today, but things to reflect on. It's like, are things happening? Like the portfolio I have, is it built for the my particular needs, the world we're in, where we're going, not just how I think things are supposed to be. Because the market doesn't care about how we feel about the market or the stocks that we in. The market's the market. And so we need to build appropriate portfolios with that in mind. Our time horizons appropriate. If I need money tomorrow, it probably shouldn't be in excessively risky stock. we probably should have safer assets to pull from in those periods of adversity and not be swayed by the headlines. And then again, markets aren't always crashing, they aren't always booming either. Sometimes they're just choppy sideways. Like, can we survive in an environment like that too? And we design portfolios and processes that are meant to facilitate success in all of those environments.
I love that. Well, let's jump to our key takeaways and let our audience leave almost on time. This is pretty close. We're right at the top of the hour. So, what
So,
if want to add anything here? We got headlines change daily,
yep.
fundamentals evolve gradually, and you've talked a lot about all these. Really,
Yeah, it's the data. The data, the headlines move fast, but the data can be a little more gradual. And so we want to take a second to sit and think and make sure we're making well thought out decisions opposed to just reacting too quickly. Volatility itself isn't the enemy. There's uncertainty that's persistent in the markets. It doesn't mean something is necessarily broken or that a plan is at risk. It's just something we have to come to grips with and find the right amount of volatility that we can stomach so we can stick to a well thought out plan. And that's all part of just being disciplined. You kind of run your own race. You do things based on what your needs are, not based on what the media is telling you, your neighbors, your friends. It's your money, your plan. We need to focus on what's right for you.
I really appreciate those key takeaways. I hope everybody else does. Uh, we really appreciate all of you being with us again this month. December 31st, we had a great turnout. I guess, Adam, we had our best turnout ever. We celebrated to help you guys get ready for New Year's Eve. So I'm happy about that. And we're happy you're here today. And please join us next month. And if you can, bring a friend. We look forward to entertaining you with words of wisdom and some sage advice from Adam Recker. Thank you.
Thank you.